Hello everyone, welcome to my channel. Today we will delve into the fascinating world of Sharpe ratio and explore how to calculate it using Python. The Sharpe ratio is a fundamental concept in finance, but contrary to popular belief, it is not a fixed or a constant number. It dynamically changes over time as market conditions fluctuate. So in this video, we will employ Python to calculate the Sharpe ratio and create a chart that showcases how it evolves over time. So let's begin by revisiting the definition of Sharpe ratio. According to some textbooks, the Sharpe ratio represents the excess return of a portfolio over the risk-free rate divided by the standard deviation of the portfolio's return. However, the original definition of Sharpe ratio by William Sharpe slightly differs. The denominator in this case is the standard deviation of the portfolio return minus the benchmark return. Here, the benchmark is typically considered the risk-free rate, which remains constant. As a result, the standard deviation of the portfolio return minus a constant value would yield the same value. Now, let's touch upon another related concept, the information ratio. Interestingly, the information ratio has the same definition as Sharpe ratio. It is essentially a generalization of Sharpe ratio. Now, let's delve into generating the Sharpe ratio using Python. To begin with, we will need to download two important essential libraries, YFinance and NumPy. This will enable us to download financial data and perform necessary calculations. For analysis purposes, we will select two stocks, SPY and MSFT. SPY stands for Standard & Poor's 500 and MSFT stands for Microsoft. We will be working with data from 1st of January 2019 to 31st December 2022. And here is the glimpse of the first 5 rows of the data. And for calculation, we will only need the adjust close data. And here, we will calculate the daily return using below function. Here is the daily return for SP 500 and here is the daily return for Microsoft. And after that, we will need to create a function to calculate the Sharpe ratio. Here is the function. We will name the function Sharpe ratio and it will take an input parameter, which is the returns. And also we will assume risk-free rate in this function is 0. And additionally, it's important to note that both return and the risk-free rate are daily, so we need to annualize it in order to calculate the annualized Sharpe ratio. By using this function, we can see the Sharpe ratio for SP 500 is 0.65 and the Sharpe ratio for Microsoft is 0.87 here. The Sharpe ratio seems to be a static figure when we calculate the Sharpe ratio for the entire period. Now, let's calculate the Sharpe ratio in a 30 days rolling window. Like this. 30 days rolling window means we will calculate the Sharpe ratio for each 30 days period, moving 1 day forward at a time. As time progresses, the oldest data will be excluded and the latest data point will be included. So to visualize this, we will need the plot method. And as you can see, the fluctuation in the Sharpe ratio is quite significant due to the relatively short 30 days period we have selected. And now, let's take another different approach to present the distribution of Sharpe ratio using histograms. The horizontal axis will show the value of the Sharpe ratio and the vertical axis will display the count of their occurrence. Upon analyzing the histogram, we can observe the highest frequency The highest Sharpe ratio frequency for SP500 is Sharpe ratio around 10, and the lowest Sharpe ratio is around minus 7.5. And the chart is not symmetric, and the most frequency for SP500 is slightly above 2.5, and for Microsoft the highest frequency is slightly below 2. Lastly, let's make a comparison between the SP500 and Microsoft by plotting their Sharpe ratio in a histogram. This histogram will illustrate the difference between the Sharpe ratio of Microsoft and SP500. As you can see, in most situations, the difference between these two is between -2 and +2. And the shape seems symmetric, and it indicates that Microsoft doesn't constantly outperform SP500, even though the Sharpe ratio of Microsoft is higher than the SP500. The Sharpe ratio, while widely used, it is not without its drawback. Let's explore two key limitations. One limitation is that Sharpe ratio can be exaggerated when based on a short track record. As you can see from our previous chart, the Sharpe ratio can fluctuate significantly from 10 plus to -7 within a 30 days rolling window. Short-term fluctuation can lead to a inflated or deflated Sharpe ratio, making it challenging to make an accurate assessment based on the limited observation period. Moreover, using Sharpe ratio as a sole criterion for selecting portfolio manager can be inefficient. Sometimes it is beneficial to hire manager with even a negative Sharpe ratios. This counterintuitive approach can improve portfolio diversification, as adding a manager with a different return profile can enhance the overall risk-return trade-off. The Sharpe ratio has another drawback. It can be easily manipulated. Some portfolio manager may resort to the strategy that artificially inflate performance in order to achieve high Sharpe ratio. Suppose we create a portfolio by taking a short position on an out-of-money put option. The option is considered out of money because its strike price is much lower than the current market value. By adopting this strategy, the portfolio would generate an immediate positive payoff with a relatively low volatility. In reality, the risk and the reward of such strategy might not be as favorable as indicated by Sharpe ratio, and there might be hidden risks associated with it. There you have it. We have discussed the Sharpe ratio definition and how to calculate it using Python, particularly within a rolling window to observe its dynamic nature over time. And we also explore the drawbacks associated with the Sharpe ratio. The Sharpe ratio is just one tool in a vast majority of measures to assess investment performance and risk. So I hope you enjoyed this video and find it insightful. Thank you for joining me, and see you next time.